Good morning, distinguished guests. I would like to very warmly welcome you all to today's derivatives market webinar that is organized by Nigerian Exchange Limited in collaboration with the esteemed Chartered Institute of Stockbrokers of Nigeria. We are glad that you have joined us. It's a day that we have been looking forward to for a while. Earlier this year, many of you will be aware that NGX launched West Africa's first exchange-traded derivatives market with equity index futures contracts. Building on this milestone, we made a deliberate decision to collaborate with the Chartered Institute of Stockbrokers to deepen the knowledge of the investing public on derivatives products, owing to the shared aspiration between NGX and CIS to promote and protect the interests of the securities and investment profession by upholding the highest standards of service and integrity. Many of you will be aware that the CIS, some would argue, are the custodians of the Nigerian capital markets, and we are glad that we have this collaboration together today. As a multi-asset exchange, NGX is uniquely positioned to develop the Nigerian capital markets through the introduction of innovative product solutions such as derivatives. We believe that derivatives will potentially address significant risk management needs of market participants, such as our pension funds, our asset managers, our corporate treasuries, and trading license holders, being the first line of contact for investors and market players with the necessary tools for asset allocation and cost management for effective portfolio management. Over the last 2 years, the COVID-19 pandemic has brought about unprecedented challenges for the global financial markets. And these have resulted in financial and economic crisis all around. Compared to the 2008-2009 financial crisis, the current crisis is more widespread, impacting more financial institutions across banking, asset management, insurance, and pension fund management sectors. Despite this unprecedented turbulence, derivative contracts have continued to serve their role in managing market and economic risk. According to the Futures Industry Association, the total volume of trades in exchange-traded derivatives reached 62.5 billion contracts in 2021, which was an increase of 33% from the previous year. Futures trading also rose by 14% to 29 billion contracts, while options trading jumped 56% to 33 billion contracts. Open interest stood at 1 billion contracts, up 2% from 1.0 billion contracts at the end of 2020. This is the fourth year in a row that global exchange-traded derivatives market set a record above the prior year in terms of total trading activity. It should come as no surprise that the derivatives market has experienced tremendous growth in trade volume and value despite global financial challenges. As in past years, rapid growth in the equity index and single stock categories accounted for most of the increase in trading. The launch of the NGX exchange-traded derivatives market saw the unveiling of equity index futures contracts based on the most widely followed and recognized equity indices in our markets. Those are the NGX-30 index futures and the NGX pension index futures. These three contracts were traded on day one with a value of 5 million naira, and open interest stood at two contracts with a value of 4 million naira. Investors that went long on just a single contract of the recently expired June contract, that's the NGX 30-month contract, enjoyed profits as high as 240,000 naira during the lifetime of the contract. It may interest you to know that these are cash-settled contracts, and they will provide market participants with tools to effectively hedge or express an opinion on an equity index market. Today's webinar, themed Exchange-Traded Derivatives, Enhancing the Capital Market for Robust Value Creation, is aimed at facilitating a better understanding of how derivatives work, including how the contract is traded and settled on a day-to-day basis, the margining process, and the risk management issues. We hope that learning from today's event will further spur participation in the exchange-traded derivatives market in Nigeria. In conclusion, I would like to thank two bodies, I should say. First and foremost, of course, is the Governing Council, the principal officers, and members of the Chartered Institute of Stockbrokers, Nigeria, for their unwavering support over the years for the exchange, for the capital markets, as well as for the collaboration in making this event a reality. Secondly, I would like to thank all of those people that worked within the exchange over the past few years before I joined the exchange in setting the ground and the foundation for what we have as a derivatives market today. Of course, those efforts were led by the past Chief Executive Officer of the exchange, NSE, Mr. Oscar Onyema, and we remain very grateful to him for the leadership in taking this initiative at the time. I welcome all of our stakeholders participating in today's workshop. I hope that the discussions at this event will provide each and every one of us with the required knowledge of how to build a more robust derivatives market ecosystem in Nigeria, and in turn, foster collaborative efforts to further develop the Nigerian capital markets. I thank you all for listening, and I wish you a very fruitful deliberation today. Thank you.
Thank you very much, Mr. Popola, for the warm welcome remarks. I will hand over to Mr. Oluwole Adeosun right now for the opening remarks from the Chartered Institute of Stockbrokers. Over to you, sir.
Okay, thank you very much, the moderator. It's indeed a great pleasure to be here this morning. I want to first extend great appreciation to the CEO of the NGX Exchange, Mr. Timi Popola, who has worked assiduously on getting this webinar up and to hold today. I want to say thank you very much for your collaborative efforts on all of what we have been discussing that has brought us to this day. It is indeed a great day. I also want to welcome all our great panelists that are on the call today on this webinar and all the participants. I'm sure you will indeed have a great experience today, a turnaround experience that will turn around our market for good and expand the market for greater participation and greater measures and profits in the name of Jesus. So I want to say, ladies and gentlemen, it is with great pleasure that the Chartered Institute of Stockbrokers is partnering with the NGX Exchange to organize the derivatives market webinar with the theme Exchange Traded Derivatives, Enhancing the Capital Market for Robust Value Creation. My opening remarks won't be too long. I'm following in the stead of the CEO, so it will be brief because we have an amazing panel that we are all waiting, angling to listen to, and I want us to listen to our experts assembled for this. Recently, in April 2022, the NGX Exchange Limited launched the West Africa first exchange traded derivatives market with equity index futures contract, as the CEO said. So we are indeed very happy that the dream of stakeholders, which was conceived 8 years ago, as he also amplified the contribution of the former CEO of the NSC, as it was then, and now the group CEO of the NGS Group, Mr. Oscar Onyema, for his efforts in bringing this to light, and all of the development efforts that went into bringing this product onto reality in the market since April. So preparatory to the activation of the derivatives trading platform, the Securities and Exchange Commission issued rules and guidelines on derivatives trading and approved 7 derivative products to be traded on the Nigerian capital market. These products are Access Bank PLC, stock futures, Dangote Cement Limited stock futures, Guaranteed Trust Bank PLC stock futures, MTN Nigeria Communications stock futures, Zenith Bank stock futures, NGX-30 index futures, and NGX Pension Index futures. 2 of these products, NGX-30 index futures and the NGX Pension Index futures, are already listed for trading on the NGX Exchange Derivatives market. More securities, we hope, definitely will be added in future. These products are highly sophisticated, no doubt. They are also highly regulated. But over the years, stockbrokers and securities traders have been undergoing series of training on derivative instruments, And this has been incorporated into our examination syllabus as a major course to be passed before being certified as a securities trader or stockbroker. While we expect the trading platform, that is the Nigerian Exchange Limited, to provide necessary training preparatory to the commencement of trading, as it has done and is still doing, even with this webinar, we want to assure the market that stockbrokers are well prepared to embrace this initiative. As complex as it may seem, there is nothing that is too difficult that we will not be able to break through once we are committed onto getting it done. So this, we want to say that stockbrokers and market operators will embrace this new initiative. As operators, we will internalize the procedures, we will internalize the rules, the regulations guiding the trading on this asset class. We should refresh our mind with what we already know, with what we knew when we passed all of the exams and we took all of the exams, and all of our further developmental reading and trainings across various platforms, across various institutions in the past years, even up to now. We should update and familiarize ourselves with the up-to-date knowledge on derivatives. People should not be scared. People should not be alarmed that this is a terrain that is uncharted. As we said, commitment brings to reality every vision. And as we commit to doing this, we will get this done. And in a matter of a month from now, we'll be saying, oh, okay, if we had known, we would have even gone into this many years back. So we should position ourselves to take advantage of these unfolding opportunities and actively participate in this segment of the market. Derivative instruments traded on the exchange are essential in the market. They are essential to help us make the market more sophisticated. They are transparent financial contracts guaranteed against default. They represent or they present a useful risk management tool for implementing risk mitigation or hedging strategies against financial risk, while also presenting an alternative investment asset class, useful for pursuing cost-friendly diversification and investment strategies. In broader financial markets, derivatives play a vital role in supporting price discovery, competitiveness, and market efficiency, which help to attract capital flows, reduce cost of capital, and deepen the financial markets. And above all, you still make profit. You can, I mean, what the CEO said about those that invested in this, that participated in this first trades and the profits that they have made over a little, barely 2 months. So it's an area that we are going to pursue diligently. We're going to encourage our members to pursue and also bring in others on board to be able to trade this product, acting and working in collaboration with the NGX-CIS. So the Charter Institute of Stockbrokers has a statutory mandate to train and certify traders on the Nigerian capital market. The Institute has over the years provided intellectual leadership in the conduct and practice of finance, securities, and investment in Nigeria. The Institute is prepared today more than ever before to produce the much needed qualified manpower traders for the new derivative market. This webinar is aimed at deepening the knowledge of participants in derivatives products and expose them to the various applications of equity index and single stock futures contracts, including trading and arbitrage applications, and a range of investment fund applications. So as we commence this webinar effectively with our panelists coming on board, I want to, on this note, wish everyone a wonderful and impactful training session. Thank you very much.
Thank you very much, Mr. Adeosun, for the opening remarks. Mr. Adeosun is the president of the Chartered Institute of Stockbrokers Nigeria. Thank you very much, sir.
Thank you.
So now we'll go into our presentations. The first presentation of the day would be taken by Mr. Ade Omoleiwa. He's the managing partner at Ademola Omoleiwa & Co. He will provide an overview of the derivatives and give an investment approach. Over to you, sir.
morning, all.
Good morning, sir.
Adeomola is my name. The previous speakers, my bosses, it has been very exciting for me to come and make this short presentation. In this just 20 minutes, I'm supposed to talk. I'm taking us back to the classroom to give us an introduction of derivative products and market. We start by looking at the concept derivatives. This is not the derivative of mathematics we did in our various schools, where you start to integrate or differentiate. But here we are talking of a financial instrument. When you say a product is a derivative product, we have an agreement between two counterparties to buy or to sell. That financial instrument derives its value from another asset or security. For example, if I have a contract to buy dollar, maybe from First Bank, they're going to give me dollars. We agree I will need that dollar in 3 months' time. We agree the exchange rate today, and that contract is binding. The concept derivative here, that contract derives its value from the asset that underlines that contract. In this case, dollar. The value of that contract, the value of that derivative comes from the value of dollar. Take, for example, if the exchange rate that we agreed is 400 naira, that in 3 months' time, First Bank is supplying me dollar at naira exchange rate of 400 naira. That contract has value to me. That contract has value to First Bank. The value depends on the strength of dollar in the exchange market. If at the end of 3 months, dollar is selling at 420 naira, that is not the business of First Bank. The business is that we have agreed a price, and that price is 400 naira. They will deliver dollar to me. I will pay 400 naira, not minding the fact that dollar is selling in the market at 420. We can no longer discuss. We can no longer discuss that what's happening. What I'm giving to you is selling in the market at 420. Why do I want to give it to you at 400? But that is the agreement. In that situation, the value of that contract to me is driven by the strength of dollar in the market. For every derivative instrument, as I have said, there is a buyer and there is a seller. one of the two parties will lose, one of the other party will gain. The gain of one of the party is the loss to the other. Hence, we say for derivative instrument or trade, it's a zero-sum game. In the scenario I have painted, we have agreed 400, but the market rate at expiration of that contract is 420. Too good for me. I have gained 20 naira. First bank or the other party has lost 20 naira. That is the concept of derivative, that the value of the contract is driven by another commodity or another asset or another instrument. We have what we call the cash market or the spot market. I can walk in, if I have all the documents to Zenith Bank today, to buy dollar. In that case, there is an exchange rate which is determined, it's already there. I am buying in the cash market. The rate today, that is, I'm operating at the spot market, and they are giving me dollar at the prevailing exchange rate today. In that case, we are not looking forward. We are taking the transaction today, we are agreeing today, they are paying for the dollar today, and they are delivering the dollar to me today. In derivative, the story is slightly different. There is agreement today, but delivery will take place in future. In the scenario I have painted, the dollar will be delivered to me in 3 months' time. Not today, but an agreement. The agreement is signed today. And as I have said, the agreement is binding. Take note that we do say you buy a derivative or you sell a derivative. For example, in the forward market, that is forward contract. We talk about selling the forward contract. We talk about buying the forward contract. The agreement between me and First Bank, for example, that I am going to buy, I'm going to buy dollar from them. In that case, I am buying the contract. I am buying the contract. First Bank is selling the contract. I am described as the long party. I have gone long. First Bank has gone short. First Bank is selling, I am buying. Yes, we use buy and sell today. Let us remember that there is no exchange of money as of today. Even when I say I have bought a forward contract. Rather, what we have done is that I have agreed to buy dollar at the future date. Between me and First Bank today, there is no exchange of money, in which case delivery is in the future, payment is in the future. In this short presentation, we will look at forward contracts, we'll look at future contracts, briefly look at option and swaps. Specifically, talking about forward contract. A forward contract, that are in forward contract, one party, which we call the long, agrees to buy, and the counterparty, that we call the short, agrees to sell a physical asset or a security at a specific price on a specific date in the future. The key features: forward contract, customized, it is unique, it is specific to the need of the two parties. That contract is binding. None of the two parties has option to exercise. Whatever happened to the price of that asset at the expiration of the contract, we can't talk about the price at that point in time. The price is determined today and is binding. There is what we call counterparty risk in forward contract. What risk are we talking about here? In 3 months' time, if the exchange rate has moved against me, I may decide not to buy dollar from First Bank. I may just evaporate. Or I get to First Bank, they say there is no dollar. I've used organizations like First Bank that ordinarily that will not default. But forward contract could be between Mr. A and Mr. B. Any of these two parties can refuse to perform. And therefore, A takes the risk that B will default. B also takes the risk that A will default. That's what I mean by counterparty risk. And it exists. Why does that risk exist? Because that agreement is a private agreement. It's not regulated. It's not regulated by any organization. Like talking about regulation by the stock market, it's not regulated. In forward market, it's a private agreement. So there is considerable counterparty risk. And that takes us to OTC, over the counter, which simply means that this contract is not traded, it's not regulated, as I have said, and it's a big problem. Then the last one here, forward contract offer flexibility. It can be designed to the needs of the two contracting parties. There is no question of standardization. It is flexible. I can go to Coca-Cola today that in 3 months' time, my son is going to engage in wedding. I will need 500 crates of their product. We sign, we agree the price today, delivery will take place in 3 months' time, and then payment will be made. It could be any quantity, it could be anything that is okay for the two parties. These are the situation with forward contract. This very short example, Mr. Miller enters a contract on 1st of January, 2022 for the purchase of 100 tons of maize from Mesa Farmer on 30th of June, 2022. This is a classical example of a forward contract. Mr. Miller has an obligation to buy maize from Mr. Farmer as at that date. Mr. Farmer has an obligation to sell. You can see here, for the two parties, the emphasis is obligation. The long has obligation to buy, the short has obligation to deliver. So in this case, Miller is referred to as the long, the guy that has bought the contract. Remember, buying the contract today it actually means we are agreeing. He's agreeing to buy that product in 3 months' time. As I have said before, there is no movement of cash at this point. And farmer has decided to sell. What will be the motivating factor? Why would Mr. Farmer want to sell the product? It could be that his product is not ready in the farm. And he fears that in 3 months' time, when his product will be ready, so many other farmers are bringing their product to the market. And the forces of supply and demand will bring down the price. And therefore, Mr. Farmer wants to lock in the price today. This example talks about a commodity. It could be anything. It could be stock. It could be stock. Something can motivate me wanting to go into forward contract on Zenith Bank shares today. I want the share to be delivered to me in 3 months' time. It could be that I fear that because of this event, the price of of Zenith Bank will jump up between now and 3 months' time. I'm not willing to buy today. It could be that the money, the cash is not available to me today to buy. but the money will be available in 3 months' time. And between now and 3 months' time, the price of Zenith Bank might have gone up. So I have a forward contract that you will deliver this quantity of shares for me at this price, and that is forward contract. Now, future contract, which is our key issue, why we are here today. Future contract. If a forward contract that is standardized and exchange traded, that is, all other factors remaining the same, forward contract and future contract are the same, except that for future contract, it is exchange traded, standardized, and so many other things that we will see as we go forward. Highly regulated. Like for forward contract, if my counterparty defaults, the only option I can do to force him to perform is to go to court. And you know what it takes to get judgment from court. However, for future contract, there is that organization that regulates, that interposes himself between the two parties, that will enforce compliance. And that is the third point here. It is backed by the clearinghouse. Then future contract, unlike forward contract, requires daily settlement. Well, I can call that settlement daily valuation. That contract is valued on daily basis, where we can establish gains or losses for future contract. Moving forward, we put them side by side. When you look at operational mechanism, forward contract, as I've said, is OTC, and therefore it's not exchange traded. Whereas future contract is exchange traded, regulated. Contract specification for forward contract, because forward contract is usually unique. Therefore, forward contract 1 may certainly differ from forward contract 2, etc., etc. Whereas for future contract is standardized. It's standardized. So many things are standardized. The size of the contract, the time of delivery, the quality, standardized, so that everybody knows what we are going into. And that has its own implication. When we look at the other one, counterparty risk. For forward contract, as I have said, it does exist. But for exchange traded, it does exist, but there is somebody that is willing to take the risk. And that is the clearinghouse. That is the clearinghouse that stands between. Because, as we will see in this paper, every seller sells to the exchange and every buyer buys from the exchange. The credibility of the exchange is the guarantee that I have, that gives me comfort that I can go. Because there is a change between the two of us, I can be rest assured. I can go into this contract, go and sleep and close my 2 eyes, because the exchange will make sure both parties comply. And if any one of them is defaulting, then the exchange will stand in. Liquidity. Because forward contract is unique, the liquidity is low. It's not easy for me to get another person to buy my forward contract. Remember that forward contract will have been designed for my own needs. My needs may be different from other people's needs. And therefore, the secondary market on forward contract is almost zero. But for future contract, highly liquid, because it can be traded, it can be sold, it can be bought. Price discovery is poor. The price I go into in negotiating with other party depends on my knowledge of the market, etc., and my ability to negotiate. The story is quite different for future. The story is quite, because it's driven by forces of supply and demand in the market. Next, we have that. This is what I said the other time. Every seller of future contracts sells to the clearing house, and every buyer buys from the clearing house. So it stands between the two of them. Clearing house. A clearing house is an intermediary between the buyer and the seller, as we have said. What does it do? It's an agency or a separate corporation of a future exchange responsible for settlement of trades, clearing of trades, delivery of trades, collecting and maintaining margin monies that we will talk about very shortly, regulating delivery, reporting trade data. And I am sure more of this will be mentioned in this webinar today. How the clearing house works. But these are the key issue, the key thing we'll expect from the clearing house, especially regulation, forcing compliance. Next, a major risk in forward and other over-the-counter trade is counterparty risk, as I have mentioned. This is the likelihood or probability that one of those involved in the transaction might default on its contractual obligation. The role of the clearing house practically eliminates this risk in future contract. Now, this risk is practically eliminated because of those things that are involved in buying and selling. The key of this is what we call deposit, good faith deposit that you make, as we'll see in this paper. And the fact that the contract is valued every day. The contract is valued every day. And the exchange will not allow his name, his credibility to be rubbished. And therefore, even if the other party wants to default, this guy will step in. This guy will step in to make sure that the other counterparty perform. And if he doesn't perform, he will step in and take over the responsibility. How am I sure that this guy that is in between us himself, if everybody is defaulting and is keep on paying, will it not get to a point when that intermediary himself will go into financial difficulty? Procedures are already put in place. First,
Mr. Omolewa, good morning. Thank you. We have about 5 minutes left for the presentation.
Yay. Okay. All right. What are those things? We have initial margin, that when you are trading in the future market, it is required that you make a deposit. We call initial margin. It is calculated. We have maintenance margin. That is the balance in your account. If your balance in the account falls below the maintenance margin, immediately you will receive what we call a margin call. Come and deposit more money. And the additional money you bring in is called variation margin. I understand that I'm running out of time. Let me go to the, okay, types of future contract. I can have future contract on individual stock, like Zenith Bank, like Dangote Cement, like First Bank. I can have future contract. When I say I can buy, I can sell. Instead of buying Dangote share today, rather I can buy a future contract on Dangote. Then we have equity index future. And these are the key issue I'm sure we are discussing today. These are future based on equity index, like the All Share Index, the NGX-30 Index, NGX Oil, NGX Index, etc., and etc. They provide exposure to the broad market as a whole, or to the specific segments being tracked by above indices. These are the products that we are going to face in our market for future. Moving forward, then we have currency future, commodity future, interest rate future. No time, as they have said, termination of future contract. Termination of future contract. When I've gone into a future contract, how do we terminate? I think there are about 4 or 3 means of terminating future contract. First, a short can terminate the contract by delivering. Remember, the short here is the guy that has promised to deliver. He delivers, and that's the end of the story. He delivers, the long pays, and that is the end of that contract. Next, cash settlement. It can be cash settled. When you look at product like NGX-CIS index, it cannot be delivered. It will be cash settled. Cash settled, whatever is the difference. We promise that it will pay me X, and in the market, it is Y. At the end of the day, there's a difference between X and Y, and that is paid. And we thank God for that and move forward. Then we can also have, you can reverse the transaction by, if I have gone long on a particular stock, I have gone long, I have agreed to buy. If I'm no longer interested before the expiration of the contract, I may decide to take opposite position. I have initially decided to buy. I may now go to another contract to sell. And the 2 contracts will cancel each other. The last one, that is what we call the exchange. Exchange for physical. This is settlement of the exchange. Settlement. Remember, we have agreed, I have agreed to buy, and he has agreed to sell to me. If we want to go for this particular option, then we meet outside the exchange. We close the contract and we report back to the exchange that the contract is closed. Oh, thank God. I was rushing, but that is my short story.
Thank you very, very much, Mr. Adi, for the presentation. We appreciate it, even though we're running out of time. So now we'll move over to the second presentation. It's going to be by Mrs. Chidima Chukwuekele. She's the Chukwueke Okolo, rather, sorry for the mispronunciation. She's the product manager derivatives here at NGX. Over to you, Ma.
All right, thank you, everyone. And thank you, Mr. Omalawa, for that very insightful introduction. You've actually cut my work by half with the work that you've done. So thank you for that presentation and overview. What I want to do today is really just focus on the derivatives that we have listed on the exchange. As the previous speakers have said, we have listed index futures, 2 index futures on the exchange. So I'll be taking you through some of those contracts and then looking at our market and the macro structure and the participants we have. And also for the trading license holders and investors on the call, how you can get the trading membership, trading license membership for trading license holders, and how you can actually trade as an investor. So our product offerings, as previous speakers have said, we have actually registered 7 contracts, 2 index futures and 5 single stock contracts. We launched the market with the index futures, the NGX-30 and the NGX pension futures. There are plans to launch the single stock futures in the future, and also other products such as interest rate futures, currency futures, commodity futures, and bond futures. But for now, we have started. So we want to look at some of the key features of these futures. We're following the standard nomenclature for futures contracts. So you see the index code, the month code, and the year, which is the last digit. So for example, if we have the NGX-30 that is expiring in September 2022, it will have a code NGX-30U2. So a contract that is expiring in December for NGX-30 will have NGX-30Z2. Contracts have a quarterly March cycle, so they expire every quarter, which is March, June, September, and December. The expiration day, we're using the standard day, which is the third Friday of the expiring month. And obviously, when this is not a day, the preceding day shall follow. We list the new contract on the Monday preceding the expiration date. So for every instrument, so for example, every underlying, the NGX-30 in this case, and the NGX pension, there will be two contracts, the front month and the back month, listed at any which time, which is available for trading. These contracts expire on the third Friday of every quarter. The Monday preceding that Friday, the following contract, the next rolling contract will be listed. So there's just a short window where there are three contracts listed that will allow traders to roll over the contracts that they have. So our index multiplier for our contracts is 1,000 for both future contracts that we have. So if you're looking for the notional value of your contract, you will take the future contract price times 1,000, and that'll give you the value of the contract that you are purchasing. So for example, we have the NGX-30U2 that's trading at 1,650 and has a contract multiplier of 1,000. That means the value of that contract will be 1.6 million and 50,000 naira. Now, another feature of our index futures contract is that the tick size is 0.25. So like you have in a cash market where you can trade to the decimal. For our index futures, you can only trade at a tick size of 0.25. So as you can see on the screen, the minimum tick is 0.25, and so the contract trades every 0.25. So you will not see a contract listed, for example, at 1,650.1. It will always be a multiple of 0.25. Like Mr. Omolu had mentioned before, for index futures, we would have a daily settlement. So this is when at the end of each day, we'll have a daily settlement price for the contract. We have a methodology for calculating this price, which is based on the contracts that have traded during the day. So the first calculation is using the VWAP of the contracts traded in the last 30 minutes of the trading session. If there are no trades in the last 30 minutes, then the last 10 trades during the day are taking a VWAP of that. And if there are no trades in those last 10 minutes, they take the trades for the whole day. In a day that the contract does not trade, what we do is calculate a theoretical fair value for the contract. The closing price of the index is calculated by NGX at the last trading day around the nearest tick. The last trading day, like I mentioned before, is the third Friday of the expiration month. Please note that the settlement price and the closing price will be different. So closing price is really just the trading price on the trading engine. But after the market closes, the daily settlement will be calculated. The daily settlement price, which NGCL will speak to in more detail later, will be used for margining and settlement and collateral calculations later. A key feature here to note that is that the futures market is mark to market every day, meaning that the trader or the investor gets to see the settlement at the same time as everyone, and they are able to manage their margin and their daily profit and loss. The trading hours for derivatives is the same as the cash market, which is 9:30 to 2:30 p.m. So when we look at equity index futures, and they have a wide range of uses for various industries. So if we look at the portfolio managers, what they use derivatives futures for are for hedging their portfolio against various types of market risk. The proprietary traders and individuals usually use derivatives for speculating. So if you have a view on the market, you'll be able to express that view by taking a position in an index future. So also there's always obviously the advantage of leverage. So for example, in my previous example I had given, of the value of the contract, of one single contract, which is around 1.6 million, given the price of the underlying, you don't have to have that outlay of 1.6 million naira. You only need to put the initial margin down, which NGCL, the CCP stipulates from time to time. Right now is around 6 to 8%. So you only need to put 6 to 8% of the value of that contract down as collateral, and you'll still enjoy the same profits, the same exposure as you would to having the full value of the contract. So exactly, the leverage allows you to utilize your capital more efficiently. Apologies, I'm just trying to go through this presentation. This presentation will be available to everyone in this meeting just to catch up on the time schedule that we have. So if we look at the market participants, we have the institutional clients and the retail clients, and they do place all their orders and their margins through the trading members. The trading members place the orders on the platform, which is the NGX Extreme, and then this trade data is sent to the CCP. The CCP really sits at the center of this derivatives market, just like Mr. Moluwa had mentioned, and the CCP NGCL will give more information on that. So they really sit in the center of the market, that the buyer of every contract and the seller of every contract. They have their clearing members who, the trading members open accounts with and place their positions with them. And they have the client's margin, the house margin, and the collateral, which NGCL will speak to a little bit later. So for trading members, the functions really are to execute trades on behalf of the clients, and they manage the client's the client's margin levels and position limits. And they also post collateral with the clearing members, cash. So for our market, we're only taking cash collateral at the moment. And as our trades are also cash settled, as our contracts are also cash settled at the end of the day. The trading fees we have at the moment. So if you look at the clearing fees, these fees are much, much lower than what we have in the cash market. So we have a clearing fee of 0.04. The exchange has fees of 0.05. The trading license holder charge up to a maximum of 0.1%. There are also other fees which will be charged for custody. Sort of custody fees, which is a position management fee for holding your collateral position. But you can see from the transaction costs, these are the minimal, as is typical of in the derivatives markets elsewhere. So I want to speak specifically to the trading member membership requirements. So a lot of trading members already have a license to trade in our market. There are only additional requirements for you to get a derivatives license, and this is really around your process, and your manpower, equipment, and your technology and effective risk management processes. I won't go too much in detail, but just to point out the key things here. So around technology, obviously you need an OMS and a technology system that can help to manage your risk management system. This is really the only additional thing from what you have existing. So this risk management system will be able to systematically compute your value at risk, stress testing, maintain your net position for your position as a house and for your clients, and other details. At the moment, we have 3 ISDs that are able to produce this, to provide this service at the moment. So if you reach out to us after this webinar, we'll be able to provide you more information on that. Human resource, obviously, your trader, your settlement officer, risk management, and compliance officers as well. You need to open an account with the clearing member, which is a margin account, settlement account, and an operations account, which NGCL will also speak to more in detail. For the investors will also provide this margin account to the trading license holders, and the margin accounts be held at the trading license level with the clearing member. And the application process is very seamless. We will send information to trading license holders who are looking to become derivatives trading license holders. And we can also provide information to investors who are interested in participating in derivatives, and help to facilitate your engagement with trading license holders who are eligible to trade derivatives markets. I've already spoken a little bit about the system. Like I said, this presentation will be available to everybody on this call so that they have the information firsthand for this. So I'd like to also inform the public that we have a series of derivatives trainings available through the X Academy at NGX. These are done periodically, and information will be sent out to the market as at when the training is due. We have a training coming up in July for settlements and operations officers. We also have information on our website on derivatives market and the products that are available for people wanting to know more about the product. And also, you can also reach out to NGC Clearing for information around the clearing, the margining, and settlement process for derivatives trading. Thank you. Apologies, I rushed through that presentation just to make time for the other speakers as well as the panel session that we have coming up, which should be very exciting. Thank you.
Thank you very much, Chidinma. Thank you so much for your presentation. It was a very enlightening presentation. We have just listened to Mr. Chidinma Chukwueke Okolo, the product manager, derivatives at NGX. She spoke on the topic participating in the Nigerian exchange derivatives market. And as she said, the presentation will be available for everyone after this session. So now I would like to invite Mr. Ayokunle Adaralegbe, the Chief Operating Officer at NG Clearing Limited, for his presentation on the topic, the role of the CCP in the derivatives market. Over to you, sir.
Thank you very much. Thank you for the introduction. And also thank you to the organizers of this webinar. I see I only have 10 minutes. I'll try and synthesize my presentation within 10 minutes. So the previous speakers already spoke about products. Mr. Omolayeba delved extensively on, and he also emphasized the existence of counterparty risk in this market. So that's the main role of about the central role of CSC, of NG Clearing as a CCP. So yes, we have the CCP in Nigeria, and NG Clearing is a CCP to clear all asset classes, including equity derivatives. So I'll just take us brief straight to my presentation. So I'll talk about NG Clearing, the process we follow, the margining process, the risks, and the default management process. Again, we started NG Clearing in 2016. We was incorporated, and yes, we were registered by SEC to be a CCP for the Nigerian capital market or across all asset classes. And the role of CCP, of NG Clearing, as earlier mentioned, is that we are here to manage counterparty risks. So the truth about it is that, I mean, if you look at the life cycle of derivative contract, the prevalence of counterparty risk is higher because the life cycle of that contract is significantly higher. So we have 3 months, even up to more than a year, up to a year. So because of the existence of that counterparty risks, NG Clearing comes into the market and say, look, don't worry about the credit risk or the ability of your counterparty in that transaction or trade to fulfill the obligation. If they are unable to fulfill it, as Mr. Omolayeba mentioned earlier, if they are unable to fulfill the obligation, we will stand it. So the key thing here is that NG Clearing comes to the market to guarantee the obligations of participants in the market. So the key word is that we guarantee obligations performance. So how do we do this? To do it, we do follow some process. And the key thing we do is that we become the buyer to the seller and the seller to the buyer. So what we're saying is that, look, once you go and do a derivative contract, whatever concerns you have about the contract, NG Clearing is here, so we'll be your counterparty on both sides of the trade. So when you go and instruct your trading member being the broker firm, the firms that have done your derivative contract for you, it comes to us. By the time it comes to us, yeah, we are only seeing the trades. We may only see, you're only going to be seeing us as the other party in the transaction. And what it does that we follow a process called novation. Novation means that we terminate the existing contract between both of the buyer, the trading member, and the selling trading member, and we will not be the one that interposes ourselves to that contract. And primarily in doing this, we perform this function with clearing members. So what SEC has done, SEC has approved that banks are the only ones that can be clearing members. Currently, we have 2 clearing members who are already live on our platform, and we have other ones also who are going through the accreditation process with the SEC. So we went to do this contract. What you are saying is that you have a peace of mind. We will innovate the contract. We will net those contracts. We will calculate the positions, and of course, before even the trade, we will have collected initial margin on an ongoing basis. We manage through the process or through the life cycle of the contract. What I'm trying to emphasize is that the counterparties that we mentioned here is NG Clearing that manages this risk. And the question I also want to ask is that why do we manage this counterparty risk? The key thing I want to mention here is that it helps us to deepen. It brings confidence to our market. So if you know that if you go into this contract, this transaction, you're sure that the obligation of those contracts will be fulfilled, then it increases the confidence in our market. It helps also deepen our capital market. It also increases the availability of alternative instruments for market participants to trade in. So CCPs were not new. CCPs exist around the world, pretty much in every jurisdiction of the world. We have one in Africa. So we, and as a company, we bring to our market the best practices that already exist globally. So we are following global best standards in ensuring we're able to perform this service to our market. So the key services we bring, therefore, is, as I mentioned earlier, is risk management, clearing, and collateral management. These are the 3 tripods, or these are the 3 areas of services that we provide to the market. And in doing that, we create so much value to the market. So what that means is that we bring transparency. How do we bring that transparency? Because we're able to ensure that the concerns people have around those obligations to be fulfilled is removed. Then again, transparency in such a way that participants in this market will have access to so much information. We have, as we are doing the trade, you have access to your collateral utilization position, your trade position on a real-time basis. I'm going to speak a little bit more about that. So we bring transparency to the market. So we disclose a lot on our website. And through that transparency, we bring that confidence that, yes, there's nothing hidden in this market. But of course, the regulators will have access to this information. And so again, further entrenching confidence in our market. Loss neutralization. I mean, for some of us who are aware, of course, we know about the last financial crisis. We're also, seeing how the role CCPs play. So as a CCP, NG Clearing will do what? We're saying, look, we're giving you guarantee that if there's a failure on the market, we will step in. And in doing that, we are able to neutralize the losses. So we don't allow the losses that can arise when we close out, when we manage the default, to spread to other participants. So we centralize the loss and make sure that it's mitigated appropriately. Of course, we do that through another process, which I'm going to mention, which is collateral collection. So of course, in doing that, one of the also value we bring is that our ability to bring efficiency, both operational efficiency. So in our market now, starting from the onboarding of participants to day, there's no paper. So everything is straight through. And I'm going to speak to how we interact with all participants in the market. So, and also because of the value we are adding, our cost is very low. It also gives you the ability to be able to trade, take more positions. So because you only take, so you can actually leverage and take, if you have a good view of the market, you can leverage. So the cost of you, if you compare the cost of you trading in this market and being also clearing to other markets, is significantly less. Of course, I talked about risk management, which is central to what we do, and also the default. Default management is what we do. If there's a default now, how do we manage it? We're managing it in a systemic and orderly way, in such a way that the market is not impacted at all. So I'll just go straight through. The question, therefore, is that you've heard about the product. You've heard about NG Clearing. Okay, what is NG Clearing is all about? The question is, how do you participate? So if you want to do a derivative contract, if you want to engage in the market, all you have to do, what we also bring to the market is that we don't want to keep creating account numbers every now and then. So if you want to participate as an investor or as an institution, you engage your trading member who will open an account with you. Now, if you're an existing market participant who already has CIS account number, yes, all you just have to do is get your trading member. We will onboard you to our system through those existing account numbers. So we do such a way that we make it simple. So if you want to do now, just get in touch with your trading member and say, look, I want to participate in derivatives trading, give them your CSS account number, and that's it. Of course, because you're an existing client to them, they already done your KYC. And if also you are a new client that want to come into the market to do derivatives, you have to first go to your trading member, they open a CSS account for you, and that process will continue. So once that account is open and you're ready, you can go to our website. So there's a section of our website. So question one says, okay, we have about 7 contracts already listed. I want to take a position on this contract. How much do I need? You can go to a section of our website. It's called margin calculator. So for instance, if you want to take an exposure of 18 million. So for instance, if you have a view of the market, I just want to compare briefly about equities market. If you want to take a view of 18 million, you have to go and post that 18 million naira and to take that position. But in derivatives market, of course, where we come in terms of the margining process, what you only need, if the initial margin, I'm just giving an example now, and I have a slide to that, it's just 5%. All you just have to do is 900,000 naira. So with just 900,000 naira, you're able to take an exposure of 18 million naira. That's some of the value we bring to the market. Yeah, so you go to our website, you see, okay, I want 10,000 contracts of maybe Dangote futures, whatever. It will be the notional value, what will be the initial margin that I need. And that initial margin you post to your trading member, the trading member will pass it to us through their clearing member. So I've already talked about the how you can come in. Then trading members also participate. Of course, the main participants that we deal with in this ecosystem are the clearing members. The clearing members, because of the size, the credit adequacy of this institution, and also because of the already plugged into the system, many other factors. So a clearing member, as a trading member, you want to participate, you first have to engage a clearing member. A clearing member will, of course, have an agreement with you. Of course, you get yourself signed up with the exchange, then you can come to us. When you come to us, we have a real-time online platform where you are onboarded without any paper, any other documentation. Everything just is a click of the button, and you're already onboarded in our system. The same way we onboard the trading members, we also onboard your client. It's a straight-through process. Onboard your client, and through that same process, once you are fully onboarded as a trading member, and as a client, you're also onboarded. It's that same process that you will provide your initial margin deposit. So I did mention earlier that if you want to take, imagine, if you want to take an exposure of 18 million, you only need 900,000 naira. If the initial margin is around 5%, I'm just giving an example. That 900,000 naira will post to your clearing member, trading member, and a trading member passes to us and comes to our system. Once it comes to our system, then a trading member can go to the exchange platform and trade against that collateral deposit, which is the initial margin, which is what that means is the worst possible loss that we calculate on the exposure that you want to take. So we take that worst possible loss. Of course, that worst possible loss is based on historical volatilities of the prices, which we know that we estimate that amount. Then on a real-time basis, your trade comes in against this collateral, the real-time collateral checks, and ensure that there are no systemic issues. So I'm going to speak more about how that happens, but what NG Clearing and the CCP is bringing to the market is bringing so much confidence in such a way that we have insulated in the market in such a way that there won't be any transfer of risks to the market. There won't be any uncollateralized exposure. And also, we also have a settlement guarantee fund, of course, that we also use in achieving this objective. So, I mean, a lot has been said about the risks that exist in this part of the market. But the key thing I want to emphasize is that the main risk we face are, of course, the counterparty risk that I mentioned, which is the risk that the party in the contract will not fulfill the obligation, the principal risk, the legal risk, operational risk, and systemic risk. So both of counterparty risk and systemic risk are quite interwoven in such a way that counterparty risk can become systemic. That is where we come in. We come in and sit in the market and ensure that there's confidence in the market. So the question, therefore, is that we've talked about these risks and what we do. The question, how do we do it? How do we do it is that we talked about ensure that we are well capitalized. I mean, the minimum capital required by SEC is 5 billion, and we are capitalized to do this business. And also the clearing members that we are also interacting with, that also taking those obligations on behalf of their client also well capitalized. Of course, we know the Nigerian banks are capitalized. So we ensure that the parties that we're dealing with have adequate capital to take on the risk they're clearing for. Of course, we take initial margin. So before you do a trade, you go calculate your initial margin requirement and deposit that amount before you even do a trade. We make our market very safe, and we make these derivatives very safe for the market. So, and what we collect as collateral is mainly cash. Of course, deposit that initial margin, and also on a daily basis, during the life cycle of your contract, we do what we do on daily mark to market. We collect variation margin throughout the life of your contract. So to ensure that we have adequate financial resources to mitigate the risk that we are guaranteeing. So we already have that. Then real-time monitoring, I'm going to speak briefly. On the real-time risk monitoring, of course, as a trading member, you will see your position on a real-time basis.
We're out of time.
Oh, all right, let me just round up. So these are pretty much the risks that we will face, we manage. And I've talked about the margin, how we manage the risks. Of course, this is an example I gave much earlier around the deposit of initial margin that you do to take an exposure. Of course, I talked about you providing initial margin, and when you have the initial margin, we cannot take excess risks beyond the initial margin that you already deposited with us. And this is the process that we follow in making sure that the flow of risks is monitored on a continuous basis with adequate collateral in place. I've talked about we also carried out what we call the model validation. This is internal to us. It's part of the confidence we bring to the market in ensuring that we have adequate resources. And finally, default fund. I've talked about the guarantee funds that we deposit, that we collect. The settlement guarantee funds to ensure that we have adequate resources to guarantee the risk that we are undertaking. And of course, this is the waterfall. This is best practice globally in managing risk for the capital market. So, I mean, of course, we're still going to have many sessions where we will have more time, but of course, because I have no time, I have to rush through the slides. So thank you very much. That's the end of my presentation.
Thank you very much, Mr. Ayo Adaralekbe, the Chief Operating Officer at NG Clearing Limited. Thank you so much for your presentation. We appreciate the very informative session which you just had with us. So because we're pressed for time now, we'll go quickly into the panel session where we would discuss the role of derivatives markets in Nigeria. I would now invite Mr. John Osoha, he's the moderator of the panel, and the Nigeria country representative of Chartered Institute for Securities and Investments, UK. Over to you, sir. Thank you very much.
Thank you, and good afternoon, everyone. I want to welcome you once again to the event. We've gone through the initial presentations from the NGS, from the president of the CIS, as well as the product presentation from the product manager for derivatives at the NGS group, as well as the NG Clearing. So now I want to quickly look at the panel discussion, the role of derivatives market in Nigeria. And I want to welcome the panelists, members of the panel, Mr. Adedeji Ajadi, the CEO of 100X Consult, Mrs. Alile Olutimayin, MD for Cardinal Stone Securities Limited, and Mr. Farouk Oreagbe, partner for Karoha Capital Partners Limited. We are discussing the role of derivatives market in Nigeria. It has come to stay. The NGS group had introduced the exchange traded derivatives. What do we think is the role the derivatives market will play in the entire market, in the economy generally? These are the things we are discussing. Let me start from Mr. Farouk. In your opinion, how do you think the introduction of the exchange traded derivatives in the Nigerian capital market, how do you think it's going to go? What effect do you think it will have on the market, generally speaking?
Good afternoon, everyone, and thanks for inviting me to join the panel. As mentioned, derivative markets allow investors to unbundle and transfer risk, and as such, facilitate the management of financial risk exposure, which was touched upon by some of the presentations earlier on. That being the case, in principle, such markets should contribute to a more efficient allocation of capital and cross-border capital flow. It should create more opportunities for diversification of portfolios, facilitate risk transfer, price discovery, and more public information. However, if this is done properly, it will have a positive effect. However, in Nigeria, in the last 17 years, we've launched real estate investment trusts, we've launched exchange traded funds, and neither has had the desired effect due to poor investor awareness, poor uptake amongst the brokerage firms, and poor participation by the investing public. Most importantly, there's been poor liquidity in the product. So despite the benefits of a exchange derivative market being launched, if we make the same mistakes again, then we probably will have the same result. It is important that we have significant liquidity in the derivatives market in order to be able to benefit from some of the things I mentioned.
Okay, thank you. Very important here, pointed out very important point. You talk about the failure of the previous, some of the derivative type products introducing the market, the real estate investment trust, and how it failed majorly because many people are not aware of the benefit and of the mechanisms around the product. Yes. So let me ask Mr. Ajadi, in your own opinion, what kind of investor education awareness do you think need to be created around these derivatives products for many more people to be aware and participate in the market? Of course, the more we have people knowing how it works and participating in the market, the better for the entire market. What kind of investor education do you think we need? The kind of awareness we need to create? How can we go about achieving this?
Thank you very much, Mr. Moderator. And good morning, ladies and gentlemen, all participants. Thank you for having me here. All right, so the question from Mr. Osua, I think one of the biggest challenge, and just to support what Mr. Farouk just said, is that we have a big issue with investors' education and knowledge in the Nigerian capital market. I think we have a robust market that has a lot of opportunities, a lot of potentials, but if people are not aware of the opportunities in the market, they don't know how to position themselves to take advantage of opportunities in the market, then we are not going to be able to achieve what we are trying to achieve. So for me, various layers of investors' education, it starts with us, those of us who are professionals in the business, who are in the knowledge business, in the skills development business. Let's start with ourselves. We stockbrokers and other market participant fund managers, we need to first train and retrain ourselves because we are going to be the first contact point to sell this product to participants. That's the beginning of it. Secondly, generally to the Nigerian public, we know the abysmal level of investors' education in Nigeria. How many Nigerians are even participating in the basic equity instruments that all of us are aware of? So not to talk of derivatives. So we have our work cut out for us. We need to go out there. We need to go to the marketplaces. We need to go back to our schools. For me particularly, I know we've started this with SEC and other participants. Let that investors' education start from our youth, from the young people. Because once they get that knowledge from secondary school up to university, then by the time they grow, it's a lot easier to sell it. Selling a product to a 40-year-old man who has never bought stocks before is a lot more difficult than to sell it to those who are primary and secondary school students who have some basic understanding and who can start very early in life. So we need to go across the spectrum of the Nigerian society to educate people, to teach them what to do so that they can participate in this market. Thank you.
All right, thank you very much. I'm going to Madam, this is Alile. There is going need to increase the capital market participants and attract more investors, such as banks, insurance firms, pension funds, oil firms, and even foreign investors into our local market. Do you think derivatives can aid this? Now that we have derivatives in the market, especially exchange traded derivatives, do you think can aid this? Do you think it can attract more participants into the market?
Thank you very much, Mr. Moderator. Good afternoon, or rather good evening, everyone. Yes, I think that having more participants, right, would aid. We all know that liquidity is the lifeblood of any market, right? If you want to buy and there's nobody to sell, you can trade, right? So the more, I would like to say the more the merrier, right? So looking at derivatives, we're talking about market depth, we're talking about market breadth, and derivatives is also another alternative opportunity for people to take advantage of. And if you look at some of the people you have mentioned, some of the segments you have mentioned, like banks and PFAs, a lot of them, derivative is not new to them. If you look at non-deliverable forwards that we've had in the currency space, a lot of the banks, foreign investors already take advantage of that. So I think it's just trying to get them used to us layering derivative on equities, on index is what we need to do. And it starts with awareness, it starts with us trying to make them see the value. Mr. Jadi had alluded to investor awareness. There is a lot of opportunity, but we need to be the ones to unearth this opportunity for potential investors. So I do think that yes, more participants so that we can increase liquidity. We can also help with knowledge transfer. The knowledge that they have experience in terms of the currency space, we can bring it to the equity side. A lot of the banks do forwards, they do swaps, right? And so we can move that even to the equity side and see what we can do with equity and even commodity space. So yes, I do think that more participants should be added to this space. It can also help in terms of fostering liquidity.
All right, thank you very much, Madam. Back to Mr. Farouk. What role do you think derivatives generally play in the economy like ours? We are in their need of activating our economy, making things move forward. And of course, there are several studies that connect capital market growth to economic growth. Do you think derivative usage, encouraging firms to use derivatives in Nigeria, more firms to use derivatives?
Thank you very much.
It can possibly impact on our economy?
Well, as you mentioned, the capital market is directly linked to the economy as a place to obviously raise capital. As far as derivatives are concerned, they perform, in my opinion, 4 major roles. One of them is risk management. One of them is to enhance liquidity. They bring about speculation and price discovery. In an efficient derivatives market, you will have all these participants. And obviously, we believe that this will bring out, they will activate or develop the capital market, which ultimately will ultimately benefit the economy. In addition to that, an efficient derivative market will bring about, or should bring about, increased activity from foreign investors, from pension funds, from insurance companies, and ultimately even from the banks themselves, because the banks themselves will start to create some retail products for the retail investors, not necessarily traded on the exchange. So with all these different aspects growing, it's almost a no-brainer that if you do have an efficient derivatives market, it will benefit the economy. In an economy like ours, where we tend to import a lot of products, there's a lot of high costs. We talk about the cost of manufacturing. even, I mean, not that we're creating a product on diesel, but just trying to bring it into the present. You know, even manufacturers, major manufacturers, if we did have a derivative product on the likes of diesel, for example, major manufacturing industries would have probably taken positions on diesel when it was 200-300 naira a litre, 400 naira a litre, therefore hedging their exposure such that now, while it's at 800, they won't have to start shutting down plants. So yes, the important thing is we have an efficient derivatives market. And if we do have an efficient derivatives market, the benefits to the economy would be immeasurable.
Thank you. I quite totally agree with Mr. Farouk. Actually, derivatives affect almost all aspects of the economy. Every segment of the economy can actually be managed using derivatives, from agriculture to aviation to building and construction, the financial service sector to educational sector, even to politics. Virtually all aspects, all aspects of the economy can be managed in one way or the other with the use of derivatives, but many are not aware of this, and that's why there is underutilization of the benefits offered by the derivatives. In fact, some are even scared, and that takes me to Mr. Ajadi. Some are scared playing in the derivatives market. They believe it's, some people have described it as a very risky, dangerous product, and because of this, they are scared from coming into derivatives product. What can you say about this?
Yes, thank you, Mr. Osua. I think it's important. The number one risk is lack of knowledge. Because if you don't know the nature of this instrument, if you don't know the risk involved in derivatives, you might get your fingers burnt. You mentioned correctly, and several speakers have said it in the course of this webinar today. They are highly leveraged instruments. That means with a very small amount of investment, you actually control a large amount of contract. Now, there are two sides to that. It can magnify your profit if things go well on your side, but at the same time, it can seriously magnify your losses if actually the market moves against you. That's where the risk is. For small, inexperienced investors, you want to be careful to introduce derivatives to them, especially from the perspective of speculation. They can lose all their capital. Even in the developed market, I mean, in the US, you can't go into margin trading if you don't have minimum of $2,000 in your account. You can't go into pattern day trading if you don't have $25,000 in your account. Why? Because they know that you can, these are risky instruments. You can lose all your money. So for retail investors, small investors, inexperienced investors, they should use it more for hedging. I mean, that's the most important use of derivative for hedging. And I think one of the most important benefits to give us in this market, for those of us who are participating in the market for many years, even when you think the market, something is going to go wrong, you don't have any option. Either you want to sell off or you don't have any option. But now we now have the options. We can mitigate our risk by hedging using some of these instruments. But of course, experienced people who know what to do, who have the risk capital, who have the knowledge, can still do a little bit more to enhance their income for their portfolio by speculating in the instrument. So a whole lot of benefit for the market, but we still have to take it with care. Risk management is very essential, and we need to focus a lot on that.
Well, thank you, Mr. Ajadi. You have just said something very important. They need to be knowledgeable and being clear about why you are in the derivatives market. If you are there to hedge and you find yourself speculating, you'll be doubling your risk, increasing your problem. If you are there to arbitrage and then you find yourself hedging, doing the wrong thing, you must be clear about why you are using derivatives. Before managing your risk to hedge, are you trying to make some risk-free profit to arbitrage? Are you trying to speculate and take some risk to make a profit? You just need to be clear. But we must not exaggerate the risk around derivatives. And that will be scaring people away. a derivative is like electricity. It can help and it can harm if you misuse it. As good as electricity is, if you misuse electricity, it can electrocute, can kill. But that does not make electricity bad. And again, after the global financial crisis, many people blame derivatives for the crisis. And the US government set up a committee to investigate the real causes of the global financial meltdown. And the report that came out, I think January 9, 2011, was amazing. They mentioned issues around corporate governance failure, because even if you abuse equity, misuse equity, it still leads to problems. If you misuse any product, as simple as the product may be, it will lead you to problem. So we have a problem around corporate governance. They mentioned issues around the regulators being far behind the regulated. The regulated are far ahead, and the regulators are coming far behind. And the faulty policy of the US governments too, trying to force people to own houses when they don't have derivative, because they found AIG then, who was selling credit default swap to many banks then. Banks were giving loan without assessing the capability of the people to pay the loans, hoping that I'm going to make use of derivatives to manage the risk. So they were buying CDS, credit default swap, from AIG. And AIG was going to fail if not for the intervention of the US government, because the money in the Trade Guarantee Fund could not save AIG. And if AIG failed, all the banks connected with it will fail. The whole thing will be much more serious. So is it not derivative that caused the problem, or people who misuse derivatives are people who didn't do their basic work well, and who were just giving loans to people who don't have the capacity to pay the loan and hoping to use derivatives to manage it, and so on and so forth. So yeah, I agree it's a risky product, but if you use it appropriately, it's very, very beneficial and helpful. I have talked about managing your risk using derivatives. Let me now go to Madam Mrs. Alili. Now, you have mentioned that one key role of derivatives is hedging or risk management. In fact, it's the traditional role of derivatives. Many people know or argue that derivatives should only be used for hedging. I particularly don't agree, because if you want to use it for hedging, who will take the risk? There must be speculators who are happy to take the risk that the hedgers are running away from. So we can't have a derivative market where we have only the hedgers. It can't be possible. But hedging is the traditional role of derivatives risk management. Madam, how do you think firms can use derivatives to manage their risk exposure?
Thank you very much. So like you said, you can't just have only hedgers, right? We'll also have different participants, speculators, people who want to speculate, people who are looking for arbitrage opportunities. So it's a mix of that, really. At the start of the year, a lot of the time, most firms have a view of the markets. We either think that markets will probably go up or go down. A lot of research will tell us, so we think markets will do X% in terms of return. We think that derivatives helps you to express that view. If you think the market will go up, why don't you put your money where your mouth is, right? You can take a position to actually, prove that you think markets will go up. And if you think markets will go down, also take a derivative on that side to be able to go back. So I think that beyond just hedging, there are people arbitrage opportunities, because you also have the same asset class, right? Trading in two different markets. So there will be opportunities for people to also be able to take, their abnormalities in terms of prices to be able to take arbitrage opportunities. Beyond that, a lot of the time, let me even focus on PFAs, pension PFAs, for example, because we have like a pension index for them. They can choose, for example, most of the stocks they buy are already in the pension index. They can choose, for example, to say, okay, you know what, I want to buy the pension index derivatives to be able to optimize my portfolio at the end of the day. Because a lot of them, so part of the reason why people don't do equities is because of issues around fluctuations of price. So whether we like it or not, as we move through the learning curve in the Nigerian market, more people will use it for hedging. As they grow, right, they'll begin to see more sophisticated use of, the derivatives. But I do think that, yes, we can start with the hedging. As people see arbitrage opportunities, people will also do that too. But yeah, there are a lot of things that we can do with it. Express your views, help with price discovery. It can also help in terms of offsetting position, maybe a position has gone bad and you want to take a derivative to be able to offset that position. There are many other uses that firms can use derivatives for.
Thank you. Thank you very much. We can actually use derivatives to manage virtually all risk. All risk. I've said it before, all the risks in the economy, all the risks in firms, we can find ways to use derivatives to manage them if we have deeper knowledge of derivatives. And this knowledge is very important because misuse can lead to problems. If derivatives are misused or are used by people in an inappropriate way, or people that do not have the requisite knowledge and skills, it could lead to problem. And that will take me back to Mr. Farouk. Considering that derivatives are sophisticated instruments with grave consequences if they are misused, what role do you think regulation should play? I also mentioned when I was discussing Mr. Ajadi's comments, and I talked about the US government committee around the global financial crisis, how they blamed regulation as part of the problem, as one of the major causes of the crisis. What role do you think regulation can play in the derivatives market, particularly in Nigeria? We have the product now, we want to trade it, want to encourage many people to be part of the market. What role can can regulation play to ensure an efficient, problem-free market?
Thank you very much. You mentioned AIG, I'll mention bearings, and more recently, Credit Suisse. And in those two instances that I've mentioned, there was a breakdown in the maintenance and oversight of risk exposure. In a country like ours, and from the experience we had with margin loans, maintenance of strict margins will be needed to avoid or prevent abuse or excessive risk to the system. I cannot stipulate it this much. If the margin culture is not adhered to by NG Clearing and the trading license holders or the clearing members, we will have a problem. Ultimately, this falls on NG Clearing to make sure that the margins are maintained, but brokers will also have a role to play, and their appropriate regulation will be needed to avoid litigation. I'll give you an example. The worst case scenario as an ex-derivatives trader, there's nothing more than you get a margin call, you posted your initial margin, you get a margin call during the day, you try to ignore it, or you get a closeout, your position is closed out, only for the position to turn around and go in your favor. And at the end of the day, but the problem is you've already been closed out. You can see that happening on a regular basis here. You will need significant protection for the likes of NG Clearing by the ultimate regulator, SEC. I'm not saying they don't have it, but it's important. And for the man in the street, I think in many countries, the retail investor can't even get involved in derivatives without signing a risk warning notice, a caveat emptor, to say that they are aware of the risks involved. One area that the regulators will need to keep an eye on in Nigeria, amongst all the institutions, is Chinese walls between the traders and the risk managers. If there's a breakdown between the Chinese walls between the traders and the risk managers, then you could have an AIG, you could have a Bearings, you could have a UBS situation all over again. It's all hands on deck. Regulation is key. Protection for the likes of NG Clearing, insistence that if you're going into the retail space, the retail investors need to be made aware that they could lose more than they plan to invest in the first place. And also the whole issue about initial and variation margin. Variation margin is done during the day, within the trading day. And if there's a margin call, you have a certain period to put up the cash. If you don't do it, you get closed out, so that unnecessary risk is not transferred to the system. regulation is going to be key in this market. Thank you.
Okay, thank you very much, Mr. Farouk. He has mentioned a very important point, the need for regulation for the derivatives market and the role the regulation will play in ensuring an efficient market. And he also mentioned the need for protection for NG clearing. And of course, I listened to Mr. Ayokunle's discourse on the steps they are taking to protect themselves. Of course, the whole NG clearing as a company is all around risk management. A whole lot of risk will rest on them. They go between, they're the one stand as a buyer for every seller, as a seller for every buyer, the one guaranteeing the transaction. So a whole lot of risk is around them. Now, Mr. Ajadi, what do you think should be the role of NG clearing, and how can they further protect themselves? Because like if there are massive default in the market, and NG clearing have not provided adequate protection around itself, and that can also cause systemic problem in the entire market. What advice do you have?
Okay, thank you. Mr. Adra Legbe mentioned a couple of structures that are already in place. And I think their role is not really that complex as long as these structures and facilities are in place. For instance, like you mentioned, people will post margins, and Mr. Farouk mentioned it as well. So if a position is moving against you, those margins are available to protect the NGX clearing. The important thing is that the structure works, the system works to ensure that, once that is happening, the individual is closed out of that particular position before it gets into a loss-making situation. So the robustness of our technology, of our system to ensure that those things are applied is very critical. Somebody also mentioned earlier regarding the challenge we had with margin loans in the past. We knew the procedures. We understood what should have been done. Unfortunately, those steps were not taken at the right time, and that created the systemic crisis in the market. So once we avoid that, ensure that everybody who is participating has the minimum requirements. And of course, we talk about risk management structure for the participants and traders in the market. Once those risk management procedures are followed, and we ensure that nobody goes into loss-making position without, having their position closed out, proper margining is done, marking to the market on a daily basis. These structures are already in place. We just need to ensure that we implement them as expected. And that's the way the NGX clearing and all participants really can be protected from risk in this market.
Yeah, thank you very much. Good summary of the points Mr. Ayokunle has discussed in his paper. Need for daily marking to market to determine profit and loss. Mr. Omoriwan mentioned it also during his presentation. The need for daily marking to market to make sure we are alerted on time if there is need to make for margin calls. And of course, this basis for the margin also should be clear. Should also, because depending on the products, depending on the underlying product and the volatility around the underlying product, we have to consider that in determining how much should the margin be. Margin can be different for different kind of products. If a product is very volatile, then we should be talking of a higher amount of margin. So it should not just be a single amount as initial margin for all products. We must consider the volatility around each underlying product on which the derivative is structured in determining the appropriate amount of initial margin. That said, is between 5 to 6% or so of the amount, which is quite good. There's need also for a liquidity provider, if we can get one. There's need for insurance, there's need for trade guarantee funds, and of course, the regular check on these trading members through visitation or inspection, anything you can do to be sure that you're not taking a back and things don't go wrong and overnight that will destroy the entire market. Now, this market is new here, and we need to keep building confidence. Anything that will affect the confidence, we must run away from it. We must ensure we are building confidence daily, and that will attract much more people into the system and lead to bigger growth in the entire the entire market. Let me ask Madam, what kind of benefit do you think investors stand to gain by taking part in the derivatives market that is being sponsored by the NGX group? They have seen the benefit. They have taken time to develop the product. I registered NG clearance since 2016. Had to go through processes to get the final approval and license in 2021. Now, they have done all of this so that the investors can benefit, the market can benefit, all of us can be partakers of the benefit, of the many benefits that derivatives offer. So how can you, what kind of benefits, how can we encourage an average person on the benefits we stand to gain by participating in the derivatives market that have just been introduced by the NGX group? Thank you.
Thank you very much, Mugreto. So I think that other speakers have also touched on the benefits, right? But I could just briefly, just looking at the major benefits of derivatives, I think the very first one is portfolio diversification. We have been talking about depth and breadth of the markets. Now you have an alternative product, so investors can take advantage of something else apart from plain vanilla equity. I think the second one is a hedging tool. We've talked so much about how much derivatives is a risk management tool, can help you in minimizing your risk, or even just optimizing the portfolio return. So derivatives, they stand to gain that benefit of having that hedging tool if you buy derivatives. The third one we've talked about is putting your money where your mouth is, right? You have your views, you have strong views about where you think the market will be. You can use the derivatives to express those views, right? It might be in stock, it might be just even in broader markets where you think maybe market may go up or down as you see politics happening, and you can say a view that, oh, we think that in a year's time, this is where I think the NSE 30 will be, right? You can express those views using derivatives. So I think that, then again, we've talked about price discovery also. So I think those are key benefits that investors stand to gain: portfolio diversification, optimizing of portfolio return. We've talked about as a hedging tool, and we also talked about expressing one's view and continuing to express one's view.
But thank you very much. So there's a lot for every investor, depending on your objective for coming to the market. If you want to hedge, you can use derivatives. If you want to see for risk-free profit, you can use derivative, a plain arbitrage. If you want to take calculated risk, you can bet on price direction by speculating for profit. And these are all benefits you can take advantage of. Of course, like you mentioned, price discovery benefit is there too. Derivatives critically can point the way to what the future price will look like. So that can affect so many other decisions we'll take as an investor. Now, from what we are saying, there is need for knowledge, need for people to be very knowledgeable on derivatives. And I know that the CIS have been doing a good job, even before derivatives came to the market, before the derivatives was introduced formally into the exchange. They have been, over the years, examining people, teaching people futures and options, derivatives and all that. Have always been in the curriculum for CIS for a long time. And thanks to the presidents and the registrars, which Ajadi happened to be one of them then, that ran the CIS at the time. So the thing have been there always. So we have a lot of people with the knowledge of derivatives in Nigeria. But of course, this were abstract knowledge. Not many have practical knowledge of how derivatives are traded. So I want to ask Mr. Farouk, derivative experts and traders are very important for us to have an efficient market. How can we develop and attract these talents into Nigeria so that we can have enough experts to make this market move? Thank you.
Thank you for that. I will, first of all, I'd say training and exposure are the key. Some of us learned the hard way. On a side step, the first time I had a loss as a derivatives trader, I was put on suicide watch by my bank because they thought I was going to commit suicide. I kid you not. Discipline and the ability to manage risk are key. And institutions need to realize that not every good equity or bond trader makes a good derivatives trader. The requirements are so different. Some guys make excellent speculators. Some are more patient and use derivatives for portfolio enhancement. In my opinion, the first step to be had, so you mentioned it, we already have a certain amount of knowledgeable people here. The question is, how do we develop it? I think the first step will be to have is to create the efficient and liquid derivatives market. For this, we would need decent market makers. Market makers will bring liquidity into the market. They're not necessarily going to be trading license holders or stockbroking firms. There will probably be individual firms like the one I work for, who trade derivatives across various markets using their own capital. Once you have the market operating efficiently, it will attract the right people. Efficient market makers will provide pricing that has a decent bid-offer spread, and from there we'll create liquidity. Once you've attracted the independent capital, it allows the insurance companies, the foreign investors, the pension funds, even the asset managers. Sooner or later, we don't have options yet, but apparently options are going to be introduced. We'll have a situation where people who are just your average portfolio manager start taking positions by selling option premium to enhance portfolio performance. Within that kind of a situation or scenario, they will be able to identify people. I didn't start as a derivatives trader. I started as an equity trader. But sooner or later, they thought I was able to, I like taking risk, and it went from there. So once you've created the ecosystem for an efficient derivatives market, the institutions will be able to identify, if they're doing the various all kinds of trading using derivative instruments, even within the institution, they will start to identify who does what. So an asset manager will identify one of their asset portfolio managers who has a knack for enhancing portfolio performance by selling premium. All of a sudden, he becomes focused on derivatives. But it's going to take time. This is not something that is learned mainly by reading textbooks. If you just read textbooks and you think you know it, ultimately the likelihood is you're going to blow up. You need to have the hands-on experience. And to have the hands-on experience, we need to have the efficient market. Thank you.
Thank you very much, Mr. Farouk. Thank you. I think Chidima mentioned about series of trainings on the way. Where the more people can be exposed about the way derivatives work, and of course practically too, how the product they have on ground, how people can effectively and efficiently trade in them. So I think, like you said, a need for more hands-on training, practical training to expose the people who are interested in trading to the relevant knowledge they need to be able to operate efficiently. Like you said, reading textbook will not be enough. That would be theory. So we need practical training. So more of that should come from this collaboration between CIS and the exchange. We should do more training, even though we know that an average broker in Nigeria who have passed through the CIS exam have got some knowledge about derivatives, or it's majorly theoretical. So let's see how to organize much more practical trainings so that we can have have the relevant knowledge we need to be able to operate successfully. Now, I will ask Mr. Jadi, maybe the final question possibly. He mentioned about option not being on ground now. We have just stock index features and the single index features, single stock features will be coming on board. We didn't hear anything about option, maybe it's on the pipeline and all that. Just for to have a balanced knowledge, can you just mention some of the major types of derivatives that we expect to have? Yeah, we have started with what we have now. We have others coming. what are the other types of derivatives you are encouraging the exchange to also introduce? Mr. Molina mentioned, discuss some things, forward futures, forward is OTC. We're not talking about exchange traded derivatives, exchange traded options and others. So any comment on that, other types of derivatives you encourage the NGX group to introduce?
Okay, thank you for that. Yes, we are on futures now. That's very encouraging, at least that we have started. And I'm sure that by the time we've done this for a couple of months, maybe a couple of years, we will be confident enough to move on to the next level, which I believe are options. Options that will allow us to buy call options and put options, which are even more efficient for me, because with options, you mitigate the downside risk while the upside potentials are still there. So I think that's the natural place to move on to. And like Lily mentioned earlier, some of the other things, swaps, they've been here. But because we are now trading futures and possibly options later, it will further support the development of those other markets, the swap market as well as the forward market will be even more robust by the time people get to understand derivatives more. So I'm looking forward to getting us having options in their different dimensions in the market within the next couple of years. Thank you.
All right, thank you. I don't know how much time we still have. Loretta, do we still have some time?
Samajita, we have run out of time. Thank you.
Okay. Can I still add, Madam, the last question?
We have actually run out of time, but if it's a short one, please go ahead.
All right, so let's close with Madam. It's generally believed that in market where we have the derivatives, the underlying market there will be increase in the patronage of the underlying market, maybe the equity or the bond or the agricultural product or whatever forms the underlying for that particular derivatives. That introduction of derivatives market will increase patronage of the underlying market. Do you think that will work for Nigeria in our case?
Well, I think I agree to an extent. Can you hear me? Oh, Mr. Farooq wanted to say something.
No, I was asking who was talking to. That's.
Oh, okay, it was actually me. I think to an extent, right? Especially if that underlying instrument was liquid prior to the introduction of the derivatives. But typically, you notice that the derivatives market tends to be more liquid than cash markets, than the equities market or the underlying instruments, right? Because again, like we talked about margin, you only require a particular margin to buy that instrument, right? You do not need the entire capital outlay. So you tend to do more in the derivatives market than you do in the cash market. So yes, if the underlying instrument has been liquid prior to the introduction of the derivatives, but a lot of the time, the derivatives market tends to be more liquid than the cash market.
Well, thank you. Loretta, do you want us to have the question and answer session?
As we've run out of time, we may not be able to go on with that. But then questions in the Q&A box have been answered by some of the panelists and also Chidinma Chukeke. So yeah, we'll wrap up with the panel session right now.
Well, thank you. Then I hand over back to you. Thank you, panel members, and thank you for listening, all the participants. Thank you.
Thank you, John.
Thank you. Thank you very much.
Thank you very much, Mr. John Osoha, for holding down the panel session. It was a very enlightening session, and we're excited to have had Mr. Farooq Oriagba, Mrs. Elili Olutimayen, Mr. Adedeji Ajadi. Thank you so much for your expertise, for sharing your expertise and your knowledge on the derivatives market in Nigeria. Now we would come to the end of the webinar, and I would like to invite the Divisional Head, Capital Markets at NGX, Mr. Jude Chemeka, for the closing remarks. Over to you, sir.
All right, thanks, Loretta. Distinguished ladies and gentlemen, thank you all for participating in this fruitful event. As always, we are delighted at the deliberations and contributions from our various stakeholders during this webinar. Certainly the learnings from today's presentations and the panel discussion have provided insight on the importance and applicability of derivatives products, how it's being traded, as well as the risk management approach. The exchange is poised to develop a thriving exchange-traded derivatives market in Nigeria. Excuse me. Therefore, we encourage market participants to trade index futures contracts that we have currently listed on the NGX platform. The exchange has robust regulatory framework and technology infrastructure for the product. Also, the exchange's partnership with Nigeria's premier central counterparty, CCP, and clearinghouse, NG Clearing, will further enhance confidence in the NGX derivatives market segment, as the clearing infrastructure is of international standards, capable of reducing systemic risk and enhancing market transparency. I would like to reiterate that the exchange is very big on investor education and capacity building of market participants. The exchange will continue to leverage relationships and partnerships to organize various derivatives workshops, webinars, and conferences, all to support market education and awareness of the product. These capacity building activities will continue, as it is imperative that anyone who engages in derivatives business would have adequate knowledge of these instruments. Lastly, on behalf of the Board of Directors, management and staff of Nigerian Exchange Limited, NGX, I would like to thank very especially all our stakeholders, the market regulators, the panelists, Chartered Institute of Stockbrokers, and Nigeria Clearing for their collaborative efforts in making this event a success. I also like to thank all our participants from all over the world who have joined at this time. I thank you all for participating and do enjoy the rest of the day. Thank you.